Hello, my name is Andrew Taylor, a wealth advisor with OJM Group. Thank you for tuning in today to our presentation, Investment Taxes, Understanding the Hidden Costs Inside Your Portfolio. Please understand the advice given today is of a general nature and may not apply to your specific situation. Please consult your tax advisor or financial advisor before acting on any of the suggestions discussed today. Our firm has authored numerous books, both for physicians and affluent individual investors. If you are listening today, you can contact us for a complimentary copy of any of the books you see listed. I'll provide further details at the conclusion of the presentation. On to the topic for today, taxes. Taxes can significantly reduce returns. Many of you are familiar with the impact of taxes on investments. The chart in front of you assumes that the investor is in the top tax bracket. I think it can be eye-opening when you see this presented graphically to see what the impact may be. If you're investing in equities, you lose roughly 20% of your returns to taxes, and if we transition to bonds and cash equivalents, that number increases to roughly 37%. Also note that the bar chart on the right addresses inflation. You may be familiar or have heard of the term your real return on your investments. That's essentially taking your returns, subtracting the impact of both taxes and inflation. Now, tax management has become of even greater importance since 2013, so basically 2 years ago, taxes increased across the board for those in the top brackets. We experienced a 24% increase in the top ordinary capital gains rate, a 58% increase in the, 24% in the top ordinary income rate, 58% increase in the top capital gains rate. Most financial institutions have not actually invested the resources to account for some of these changes. I'll get into some of the reasons why as we move further into the presentation. In front of you, you see an illustration of the history of the top marginal tax rate in our country's history. While it may feel that current rates are high, they are actually low on a historical basis. Given our nation's debt load, current demographic trends, the increasing cost of our entitlement programs, it is reasonable to believe that the top tax rates are not going to be declining anytime in the near future. So what are some techniques you can utilize to reduce your investment tax bill? Some of these you may very well be familiar with. Take advantage of the account registration type. Understand which accounts are exempt or tax favored. Own actively managed mutual funds that have a higher tax liability, and traditional bonds and deferred accounts. Own ETFs and individual stocks, which tend to be more tax efficient. In non-retirement accounts, own municipal bonds in taxable accounts. Municipals is one instance where 3% actually is more than 4% if you're in the highest tax bracket, which you adjust for your true real return. Be aware of holding periods. There's a very significant difference between owning a security for 11 months versus owning it for 12 months. Make sure you offset gains by realizing losses. This is just a very short real-life example of what we did for a client a year ago. $3 million portfolio, $194K in gains. 50 of that had been realized. We were able to offset the tax impact of some of those gains by selling foreign securities, which experienced a loss last year, as many of you know. This was $7,000 in reduced tax liability for the particular client. And then the final point, understand your mutual fund or ETF's tax cost ratio. I'm going to explain this further in just a moment. So why are some of these techniques that I just mentioned not a standard practice for every advisor in our profession? There's multiple reasons. And the fact is, most assets invested in the market are in tax-advantaged accounts via pensions, endowments, 401k plans. Taxes are really a non-issue in these types of accounts, at least during the accumulation phase, certainly. The typical advisor client is not in the highest tax bracket. The profile of what you'll see at most advisory firms, if they have $1 million client, that typically $750,000 of that is going to be in tax-advantaged accounts via an IRA rollover or a 401k plan. So the assets in taxable dollars typically is not that significant. And the reality is there aren't very many individuals who are in the highest tax bracket. Someone with an adjusted gross income on $250K in the example that you see in front of you, they're in the top 4% of all filers. Once you factor in deductions, you're probably looking at a 28% tax bracket. This fits the profile of a corporate executive. You simply don't have many individuals who are in that top bracket. Another reason wirehouse broker advice is product driven, so it's great to serve the masses. It's built for scale. It's not necessarily advice that's most suitable for the affluent. Separately managed accounts, some of you may be familiar with, they own 80 securities. You have a tremendous amount of turnover. You may be led to believe that they're tax efficient. Typically they're not. Mutual funds tend to be very, very poor offenders of creating lack of tax efficiency. They have revenue sharing arrangements with the firms offering them, so while they may be very profitable for the underlying firm, not necessarily an optimal strategy for tax efficiency. And the last reason is time consuming, and many of you, it is time consuming to explain the benefits of tax efficiency. Many of you on this, listening to this video may be guilty yourself. How many times have you said, I'm not really interested in hearing what's happening in China or what Greece is doing to the financial markets, just give me the bottom line. What did my portfolio do last year? Well, remember I made the reference that in some cases 3% is actually more than 4% when it comes to municipal bonds and fixed income. It actually takes an advisor some time to explain the benefit of tax efficiency, and what you keep is actually what matters, not necessarily what you make. So net returns are critical. Many advisors don't want to actually take the time to explain some of the benefits of the tax efficient strategies. So back to our point of the presentation, which is what is tax cost ratio? What is this hidden expense that we're bringing to your attention? The basic definition, tax cost ratio, measures how much of a fund annualized return is reduced by the taxes investors pay on distributions. So mutual funds tend to distribute, and they do distribute stock dividends, bond dividends, and capital gains to their shareholder to maintain favorable tax treatment for the fund itself. Now you as an investor have to pay taxes on these distributions during the year in which they received, even if you actually experience a negative return in your mutual fund. It is possible to have a tax liability in that circumstance. Now, you may not remember this definition when you walk away from the presentation today, but think of it very simply. The impact of tax ratio on your portfolio is the exact same as the expense ratio on a mutual fund. So it is a drag on your net return. The typical tax ratio for an investment is anywhere from 0 to 5%. The higher the number, the less tax efficient the strategy. It does not assume a liquidation of the security, and it typically will assume that the investor is in the highest federal tax bracket, does not take into account any potential state tax liability. This is a listing of the 3-year tax cost ratio for a variety of investments. We've chosen a large cap fund, a small cap fund, and a foreign investment. As you can see, with diligent research, tax cost ratio can be reduced by an average of 1 to 1.5%, potentially even further if it's a year where there have been substantial gains. Now we have also run a case study, and we'll take you through a quick example. Now keep in mind this is a hypothetical example. It may not necessarily apply to your specific situation. Clearly it's assuming a taxable account and someone in the highest tax bracket. But as you see in front of you, we evaluated 2 investments. They had the exact same reported return, and the only difference in results are the tax cost ratio of each of the investments. Investment 2, the client saved over $23,000 in taxes over a 3-year period. Now, recognize that this was only on a $100,000 investment, and it was only over a 3-year period. So you can think about the potential compounding impact and the savings that you would realize over the lifetime with a proper tax-efficient investment strategy, recognizing tax cost ratio. Before I conclude, a few words about our firm, OJM Group. We are not exclusively an asset management firm. How do we work with clients? Well, we have a very diverse team with a unique set of backgrounds and expertise. We provide guidance in the areas of asset protection, tax reduction, corporate structure, benefit planning, retirement planning, insurance analysis, and wealth management. OJM Group is a unique fee-based national consulting firm. We have 1,000 clients in 48 states. We provide planning services both on a personal level and a corporate level. So I do want to thank you very much for listening today. As I had mentioned, anyone who is on the webinar has the opportunity to receive a free book for doctors only, fortune building for business owners and entrepreneurs, or any of the other books that you saw at the inception of the presentation. We would also like to offer a free consultation for anyone interested. If you would like to schedule a consultation or receive a copy of our book, you can log on to our website or our bookstore, www.ojmbookstore.com. You can use the promotional code WEB0915 at checkout, or you can simply contact our office. You can contact me at 877-656-4362, or send an email, ataylor@ojmgroup.com. Thank you very much for listening.